I published a new blog post earlier this evening discussing most of my small ball stock purchases and most of my corporate bond purchases for the week ending on April 25th. Some of the corporate bond purchases that I made this last week will be discussed in my next post. Using the principal amounts I discussed buying in that blog, $5,000 in a AAA rated Tennessee municipal bond maturing in 2029 with a YTM of 3.6%, 15,000 in investment grade corporate bonds, of which 9,000 in principal amount were either first mortgage bonds issued by operating electric utility companies or senior unsecured debt issued by electric utility companies. $10,000 in treasury bills purchased at this week's auction, and about $1,500 in small lot purchases of dividend paying stocks. I have been increasing my average bond duration and YTM over the past several weeks. This is in part due to my heavy weighting in short-term maturities, particularly treasury bills, and the possibility that the Fed may lower the federal funds rate, which will cause those short-term securities when they mature to roll over at lower rates and yields. In my Fidelity account, I've increased my bond duration to 2.747 years from 2.47 years as of 2/2025. Fidelity provides this information so that I can keep track of it. I view it as important in managing my bond portfolio. The YTM increased, the average YTM increased to 4.976% from 4.724% on February 2025. Both the duration and YTM numbers are weighed down by my significant weighting in treasury bills and Tennessee municipal bonds that have lower coupon than taxable bonds. I am buying more senior unsecured bonds issued by electric utility holding companies and discussed some in the most recent blog, and first mortgage bonds as well, issued by the utility operating companies. That is a response to my growing unease about where the U.S. economy is headed later this year. All of the stocks discussed in the blog, this last blog post, pay dividends, and I'm mostly averaging down in three beaten up sectors: equity REITs, regional banks, and packaged food companies. I'm only buying small lots, generally 5 to 10 shares at a time, sometimes less than 5. The purchases discussed are at prices lower than my last buys for those stocks, so my average cost per share is decreasing some for these purchases, and the dividend yield is rising. I did not sell any stocks or stock funds this last week. I'm generally buying $1,000 to $2,000 in stocks and stock funds each week, starting with the major downturn that occurred on April 7th and 8th of 2025, but will likely stop buying and switch to some selling, as I discussed in this last blog post, when the VIX returns to below 20 movement, and that is a relevant number in my VIX model. The VIX closed today at 24.84. The inflationary impacts of the Republican tariff taxes, which are regressive taxes, are starting to show up in prices paid by consumers. The first impacts are in perishables imported across the border, in products like crude oil and potash imported from Canada. The Republican tariff taxes will be the largest tax increase in U.S. history for the bottom 3 quintiles in household income. A study published at the Institute on Taxation and Economic Policy, abbreviated to ITEP, on April 23, 2025, which is available on the internet, estimates the following impacts on U.S. consumers by household income from the Republican tariff taxes. And the estimates are based on the tariffs that as they now exist. And I will be quoting from this study. Quote, if these tariffs are in effect next year, we find that for the poorest fifth of Americans who will have incomes of less than $29,000 in 2026, the tariffs will impose a tax increase equal to 6.2% of their income that year. For the middle fifth of Americans who will have incomes between $55,000 and $94,000 in 2026, the tariffs will impose a tax increase to 5% of their income. The richest 1% who will have incomes of more than $915,000 will face a smaller tax increase relative to their income, just 1.7%. This just shows the regressive nature of the Republican tariff taxes. The impacts will be less in 2025 since they are not going to be in effect for the entire year. These tariff taxes are likely to cause stagflation, and that is my major concern now. If they are continued at the current rates for a few more months, and that is one of the reasons why I will quickly start to sell stocks again when and if the rally continues, and I can sell some stocks at maybe, and I mentioned one stock fund in my last blog that I will pair when the VIX returns to below 20 movement. So I am still very concerned about where we're going in the U.S. economy.